Ladies and gentlemen, welcome and thank you for tuning in to The Street. It's an honor to have you here. But first, I want to clear some things up. I'm not talking about Nash Street. I'm talking about the Wall Street Journal. I'm your host, Mike Del Sardo. In today's show, we feature an individual who you may know as a television personality, a former hedge fund manager, or even a best-selling author. This Harvard graduate began investing while in law school. And here's a funny story for you. This man began promoting his holdings by leaving stock picks on his answering machine, which impressed Martin Peretz, the owner of the New Republic, who then gave him $500,000 to invest. He then earned Peretz $150,000 in just 2 years' time. From this point, he went on to become a stockbroker in 1984. And then after just 3 years of success, he then went on to start his own hedge fund by the name of Cramer and Company in 1987. That's right, I'm talking about Jim Cramer. During his tenure of the fund, which lasted from 1988 to 2000, he just had one negative year, and that came in 1998. But on the upside, Cramer was able to follow this up in 1999 with a positive, and that was the ability to return 47% of the fund. Skipping some time ahead to when Cramer decided it was the right time to retire, he gave the fund to his partner and continued to work as the editor-at-large for Smart Money magazine. While working as the editor for this magazine, he was accused of unethically combining his investing and reporting activities for personal benefits. That's right, he bought more stock from the requested article before it had even come out, and this resulted in a $2 million personal gain for Jim Cramer. On this very day, Cramer works for CNBC, where he's the host of his show Mad Money, and he is also the co-founder of TheStreet.com. Looking through some of Cramer's recent work, I came across an article that was entitled, "There's Nothing Wrong with Your Company." In this article, Cramer goes on to talk about just because your stocks may be down, it doesn't mean that your company is bad. Here's a quote that Jim Cramer uses in this article that is more particular to a few companies that you may have heard of, and that puts this situation in perspective. How come a name like Salesforce.com or Workday, two incredibly good companies, can have stocks that go down, while companies with prosaic, unexciting, and much slower growing businesses like HP and Microsoft can have such red-hot stocks? In this article, Cramer goes on to talk about some reasons that are particular to HP. He talks about the company's decision to boost their dividend, or the brand new three-dimensional initiative printer. He says that if you get better business formation and more growth at the enterprise, then more computers will be ordered, and slower growth companies will put up surprisingly good numbers. After researching Jim Cramer and reading through this article, I agree with the particular views that he states within the article. One of the reasons being is because if you look at the other side of things, if you look at Salesforce.com, there's absolutely nothing wrong with the company. They're a company who will get their 30% growth each year, and that'll be consistent. However, right now in the stock market, we're in a category where people don't like consistency. Whether it's boring to them, I don't know. But they're more interested in businesses or companies like Microsoft, who have that chance and opportunity for a huge gain out of nowhere. I think that Jim Cramer brings up a lot of valid points in this particular article, and there's nobody better to hear it from than somebody who lives it every day. Another article I came across that was written by Jim Cramer was one entitled "An Irrational Market." In this article, he states that right now I like the market, but that doesn't necessarily mean it's a rational market. He talks about how Macy's and Home Depot are both action alerts, but their shares rallied on disappointments, which nobody expected them to do well. So this made less bad into good enough. Boeing, Starbucks, and Walt Disney are all cooling off. However, Cramer goes on to say that healthy rallies take pauses, and that's exactly what we want. Cramer goes on to talk about how the markets continue to be irrational with companies like Netflix, LinkedIn, and Tesla Motors. He said that Netflix needs a serious rest, while Tesla only gets more and more concerning. Cramer also talks about how we have a two-track market. He said on one track, there are the rational stocks, while on the other, there are companies and stocks like Tesla, which on Tuesday, it rose over 13% after an analyst doubled his price target on the electric car maker from $153 to $320 per share. In the following paragraph, Cramer goes on to say this: the analyst making the call has indeed been right about Tesla thus far, but in order to meet these lofty valuations, Tesla would need to expand battery production at a near mythological pace. Cramer said this bold Tesla call reminded him of the dot-bomb era, which on December 20th, 1999, an analyst made a bold call on Qualcomm, raising his target from $500 to $1,000. This, shortly thereafter, the Nasdaq collapsed, and it took Qualcomm over 10 years to see its stock recover to that 500 level. Cramer discusses Tesla as I just mentioned. And now, when we return to the studio from this break, we will be joined by the one, the only, Jim Cramer. We'll be right back after these messages.
Excuse me.
Yeah.
Is that your car on the lot?
Yeah.
It's a Jag?
Yeah.
How much money you make?
I don't know, 72,000 last month.
You show me a pay stub for $72,000 on it, I quit my job right now and I work for you. Hey, listen, I quit. Yeah, I'm going into stocks.
My name is Jordan Belfort. At the tender age of 22, I headed to the only place that befit my high-minded ambitions.
Name of the game, move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
I started my own firm out of an abandoned auto body shop. We will be targeting the wealthiest 1% of Americans.
I love three things. I love my country, I love Jesus Christ, and I love making people rich. Hello?
But I needed to mold them in my own image. With this script, I'm gonna teach each and every one of you to be the best.
This is the greatest company in the world!
I was becoming a legend.
Aren't you married?
Yeah, but married people can't have friends.
We're not gonna be friends.
I was making so much money, I didn't know what to do with it.
$26,000 for one dinner!
Dad, we're not poor anymore.
Tell them about the sides.
What
are these sides? They cure cancer?
The sides did cure cancer, that's the problem. They were there, that's why they were expensive.
22 million in 3 hours!
The real question is this, was all this legal? Absolutely not.
Hang you up from the heavens.
He's got pictures of your whole inner circle. This is bad.
It's okay.
Rub my temple.
You're all right.
This right here is the land of opportunity.
You just tried to bribe a federal officer.
This is America. This is my home.
Good for you, little man. Me, the little man.
The show goes on. They're gonna need to send in the National Guard to take me out, because I ain't going nowhere!
We don't work for you, man.
You have my money taped to your boobs. Technically, you do work for me.
Ladies and gentlemen, welcome back from the break. And as we just mentioned at the end of one of Jim Cramer's articles, Tesla. And holy crap, is that Tesla not moving higher and higher? Dare we say firing on all cylinders, speed racing to the top of the charts.
You could divide it by the number of cars and say it's radically overvalued. Each car's worth $500,000. Not the way to look at it. This is a total addressable market issue, and it's also a love issue. The customers love it. Consumer Reports love it. People feel that the electric car market could be gigantic. Against that, a lot of people felt that the company was overvalued at 30 and 40 and didn't think it was making money. It was. So consequently, you've got a long-short battle, and the shorts can't find stock. They issue stock last night, and the CEO buys a ton of it.
He bought $1 million of his own stock. I mean, that is amazing.
A lot of shorts were waiting for the big equity offering, so they felt that that would be their chance to buy on it, or alternatively, that the borrow from the short selling would become easier. And you saw the stock trade at 92 down to 84 when you first saw the equity or the mixed securities, I said, and then you found out that it was equity offering. You said, oh boy, finally the tightness is going to end. The stock is going to go much lower. And then you see that Musk bought it, and then the stock flies back. And the analysts are all kind of caught because there's people with a $50 price target who have to raise the price target. This whole price target thing is proving to be a chimerical way to be able to bet against analysts. And so consequently, Deborah, what I see happening is that it's an ungameable situation. Reminds me a lot of Amazon.
And the shorts are down. I mean, they had been at 30 million, and now they're just at 27 million.
I mean, I want to buy one. I want to buy one.
Yeah, you wanted to buy one, but they told you that you had to wait 9 months.
What's a 3-month wait? Some people say only a month wait for certain models, and I'm going to be test driving one. I sat in one. When I heard that it was 9 months, I just expressed no interest. But I think that this could be. I own an inn in Summit, New Jersey, and we were charging a Tesla this weekend, and it was just really cool. And I continue to think that even the shorts want to own the car.
Now let's get back to the stock, because here we are. Is this $100 stock? Are we going to hit 100?
Again, what I always like to do is know my own limitations. Like I can value Google, but I can't value Apple because Apple's earnings are in decline. There I can just say it's got a dividend that's going to prop it up eventually. Amazon and Tesla I can't value. And I think that anyone who claims they can value them does not understand the mechanics of the market, which is that as soon as you had that equity offering last night, the shorts came back. I mean, I'm sure that we'll see a spike up in short interest. The mechanics of the market don't allow you to be able to figure out how to do it because the shorts are constantly covering. Amazon's at 200 times earnings. You can't value that because what happens if they stop spending? It immediately maybe goes to 15 times earnings. Who the heck knows? So, you have stocks that can't be gamed. They are just unfathomable.
Well, there you had it. Jim saying he's a fan of the car. He might get back on the waiting list. However, if you're looking at this stock, be forewarned, it's a risky place, and you must have a fast finger if you're going to trade Tesla.